Hi everyone, this is Joe Gentili from Sarraf Gentile LLP. In this video, I want to inject a dose of reality into the expectations that some people have with regards to the upside potential of index universal life insurance, or IULs, and fixed indexed annuities, FIAs. This video is going to focus more on IULs because what I'm saying I think is applicable in both scenarios. I think it's even more applicable, more true for IUL because of how long people hold the policies. They hold them for life. So if you've bought an IUL policy, undoubtedly you've been given illustrations, and almost certainly those illustrations are going to show a very rosy picture. If you buy the policy and invest in the indexed options, they're probably going to show that you're getting a rate of return in the indexed options over time that's exceeding, and probably exceeding by a lot, the amount of money that you would have gotten if you just stuck with the fixed account option. Now, if you understand the way these indexes work, you understand that that's not possible over a long period of time. So, for instance, if you buy an IUL and the fixed account option right now, let's just say for the sake of argument, is returning 5%, and the indexed options that you're being shown are being illustrated at 7.5%. So that's showing that you're going to make an extra 2% premium for putting your money in the indexed option, which is a large premium over time. Now, most people understand when you buy an IUL and you put your money in the indexed option, you're not investing in the actual index itself. So if you're in an S&P 500 oriented index, your money is not going into the S&P 500. It's going into the general account of the insurance company. They're earning a return on that general account. Again, let's say it's 5%. They're going to take a portion of that and they're going to go to a large bank and they're going to buy options from that large bank. This way, your money can be credited to the performance of an index like the S&P 500, and you're protected with a downside of or floor of zero crediting. So that's accomplished through options. So you put your money in the indexed option. If the index has a negative year, it's down 20%. Those options ensure that you get a 0% floor on that. So you're not going to suffer the negative return that you would have in an index. And part of the price of paying for that is usually you're going to have some sort of cap on the total amount that you can get credited, or a percentage of the gain that you can get, a participation rate. So for the sake of argument, right now, you'll see, for instance, a 0% floor, but you'll have a cap of 10%. So if the S&P goes up 20%, you're only going to get credited at 10%. Now, that sounds very good. And a lot of the sales efforts like to focus on the cap rates being high or the participation rates being high, sometimes over 100%. It's really all smoke and mirrors. To believe that over time, regardless of what those cap rates are and participation rates are, to believe that over time that you're going to do better in that than you would be if you were in the fixed account, you'd have to believe that the bank that is selling the options to the insurance company over a period of time is going to lose money doing that. That a large, sophisticated bank is going to continuously sell options that they know over time is going to cost them money. That's not going to happen. The banks know that, which is why they will engage in these transactions. They'll sell the options continuously because they know they're not going to lose money over a long period of time. The insurance companies who are creating or blessing these illustrations, showing that the indexes are returning more over time, they know that's not going to happen as well. How do you know they know that? Because if they had an options trading strategy that was going to create the tremendous upside, or could create the tremendous upside that they're illustrating, they'd be doing it on their own account and doing it themselves. and not selling you life insurance to do it. So both sides, the bank and the insurance company, they both know that over time, the amount of money that the insurance company pays for these options is going to be fundamentally, it's going to be what they're worth, minus some transaction fees. So you could expect that over time. Again, this is not true for any one given year, but over time, the return on the fixed account or the general account is going to roughly equal the return on the indexed options. And this is because the return on the indexed option is largely created by a zero-sum game between a sophisticated insurance company and a sophisticated bank. So most experts in finance understand that that is over time going to be a wash. So if you were given a policy where the illustration was shown to you that the indexed options are getting a greater return over a long period of time than the fixed account option, and that's a reason why you bought the policy and invested in the first place, because these high returns in the indexed options that were illustrated show this phenomenal accumulation of cash value, shows it's throwing off all sorts of retirement income. In my opinion, you were misled into buying the product. That is an unreasonable expectation for the returns of the strategy, and the insurance company that's behind it, I think they know that. So if you have bought one of these policies, if you're starting to see that the returns on it are not what you expected, um, and you see that it's not that easy to get out of it, especially if you're in the early years without incurring a pretty significant loss. If you'd like an attorney to review the policy, please reach out to me, reach out to my law firm. We're happy to review these situations to see if there's any um, legal solutions to trying to make you whole and getting you out of a deal that you were misled into. We're happy to do that review. We do it free of charge. And if you have any questions, just feel free to reach out. If not, also subscribe to the channel. We're going to be making a lot of videos about the intersection between law and life insurance and law and annuities. So if this is a topic that you have interest in, again, please subscribe. So hope you all have a great day. Thanks for watching. Bye.